There are mainly three types of business exist in the market. One is sole proprietorship. In the sole proprietorship business, only one owner exists. It is operated by only one owner. On the other hand, in partnership business, at least two-person should be the owner of the business. Otherwise, it will not be partnership business. There may have two or more partners in the partnership business. Corporation is a legal entity. It is ownership is separate, and it is management is also separate from its business. What are the advantages and disadvantages of sole proprietorship business? Sole proprietorship business is very easy to start. Every single person with their accumulated fund or capital, they can start their business very easily. Least regulated, yeah, it is least regulated. With the local license, they can start their business. Since owner is all for the business, so single owner keeps all the profits. As as business profit is the owner profit, that's why tax is levied on personal income. There are so many disadvantages of sole proprietorship business. If person closes the business gets dissolved. If person dies, then business gets closed. Equity capital limited to owner's personal wealth. Yeah, whatever the owner has in their hand, only that can be the equity capital for the business. All type of losses, all type of liabilities are fallen under the owner. Owner has to bear all sort of liabilities. They can since only one person is the business of the owner, so he or she has to take all the liabilities incurs from the business. Sole proprietorship, the owner of sole proprietorship business cannot transfer ownership of the business because it is in the person name. The advantages and disadvantages of partnership business. Two or more people can start the business very easily. Since there are two or more people, the contribution of two or more people makes the capital more than the capital belongs to sole proprietorship business. As like sole proprietorship business, partnership business can also start through getting local license from the state. Here, as like sole proprietorship business, income is taxed on personal income. Based on the liability criteria, partnership business can be categorized in two ways. One is general partnership, another one is limited partnership. In general partnership business, all the profits, all the liabilities are divided equally among the partners. On the other hand, In limited partnership business, all the liabilities, all the profits are divided as per the contract made by the partners during starting the business. Partnership dissolves when partner dies or wishes to sell. Yeah. When one partner sell the share, sell their share, when one person sell his or her share from the business, then partnership business also get dissolved. In partnership, transfer of ownership is possible, but it is quite difficult. The transfer of ownership depends on the agreement or on the contract of other partners. If they agree, then the partner who wants to transfer his ownership can do that. There are so many advantages in corporation. In corporation business, all the liabilities are distributed among the shareholders. If company loss in a certain year, then the amount of dividend would also be lower, will also be decreased for this period. So all the losses, all the uncertainties are distributed among the shareholders. In corporation, as it is a legal entity and it is shareholder and business are the separate entity, so it has unlimited life. If one shareholder sells its share to other investor, then the business will never stop. Then the new shareholder will be the owner of this corporation. In the corporation, the shareholder elect the board of director, the management for running the business operation. And that is why the ownership and management is totally separated in corporation business. Here, transfer of ownership is very easy, as shareholder can sell their share to other investor. Through investing their share to other investor, they are transferring their ownership. In corporation business, company can raise capital very easily. Suppose if company needs some fund for their new project, they may raise capital through issuing shares in the capital market. The only one disadvantage in corporation business is double taxation. Every shareholder has to go through double taxation. One tax is imposed on their corporate income. Another tax is imposed on the dividend they earned from the business. Goal of financial management. What should be the goal of a corporation? Maximize profit, minimize cost, maximize market share, maximize the current value of the company's stock. Yes, all are the goal of a corporation. Every corporation works to maximize their profit, to minimize their cost, to maximize the market value of share, maximize the current value of company's stock. Does this mean we should do anything and everything to maximize owner wealth? Yes. Whatever the company does, they does, whatever the company does, they do to maximize the owner wealth. If owner wealth is maximized, then definitely the business growth will also increase. If business growth increases, then share value also will increase. The agency problem. In corporation, stockholders are called principals and agents are called managers. Stockholders hire managers to run the company. The managers are bound to work for the best interest of shareholders. When shareholders' interest is in question, then there may have conflict of interest between principal and agent. Managers are responsible to make any sort of decision for maximizing the value of the shareholders, for maximizing the wealth of the shareholders. Agency problem can be minimized in so many ways. Company may adopt some regulations and the managers must follow these regulations. If managers follow these regulations, then they may go through certain disciplinary actions. They may go through a format, then conflict of interest may not be happened. On the other hand, shareholders or principals can increase the manager's salary, manager's compensation package to manage the dissatisfaction among the managers. Thus, it will reduce the conflict between the principal and agent. Even shareholders may adopt the threat of dismissal. If they give threat to the manager, if they do not work as per the guideline, as per the orders come from shareholders, they may get fired. So these are the ways that can minimize or that can solve agency problem. Financial markets, actually it is a marketplace where people trade financial instruments. Financial instruments like bond, stocks, and so many things. It may be a financial derivatives, it may be commercial paper, it may be bill of exchange, and so many things. Financial markets can be categorized into markets. One is primary market and another one is secondary market. Primary market is a market where firms sell securities for the first time to the public, and it is called initial public offering. When a firm wants to raise capital from the capital market, they may issue IPO to generate capital for the first time from the primary market. When firm generate capital for the first time, they raise capital from the primary market. Once IPO is sold in the primary market, then it is traded in the secondary market. Secondary market is a marketplace where securities are traded among the investors. It is about that securities which are already sold in the primary market are traded in the secondary market. There are some forms of secondary market like dealer, auction market, listed, over-the-counter market. In dealer market, the market participants like seller and buyer do not confront each other. All the transactions happen through the dealer. On the other hand, in auction market, there must have an auction. Based on the auction, the financial instruments are traded as per the highest bid price, which matches with the asking price. New York Stock Exchange is one of the examples of auction market, and Nasdaq is one of the examples of dealer market. Listed securities are those securities which are traded in the market which is regulated by Security and Exchange Commission. On the other hand, in the over-the-counter market, any company, even unlisted company, can trade financial instruments. New York Stock Exchange is also an example of over-the-counter securities. Financial markets based on security type. Money market is a marketplace where financial instruments are traded to generate short-term fund. The maturity of these financial instruments is 1 year or less than 1 year. The next one is capital market. If company wants to raise capital for their business, they may raise from both equity market and from debt market. Through issuing equity and debt, they can get fund for their business. Derivative market. At first, we should know what is derivative. Derivative is an arrangement or product whose value derives from and is dependent on the value of an underlying asset. An underlying asset of the derivative contract is the one that is to be bought or sold on a future date. An underlying asset can be commodity, currency, or security. Now, the derivative market is the financial market for derivatives, financial instruments like future contracts or options. which are derived from the other forms of assets. For example, if you want to buy a house whose value is about $20,000, but you don't have money to buy the house now, you may create a contract with the owner of the farm or owner of the house that you will buy the house after 1 year at the price of $21,000. If you able to make the contract, then if the market value of the house increases to $25,000, it will not impact on your contract. Based on the contract, the owner is bound to sell you the house in $21,000 within the contract period. That types of contract, that types of transactions are mainly happened in derivative market. Depository markets. In depository market, depository institutions are mainly play their basic role. Depository institutions are some financial institutions such as savings bank, commercial bank, savings and loan association, or credit union that are legally allowed to accept monetary deposits from consumer. It contributes to the economy by lending much of the money saved by depositors. Then the last one is non-depository market. In the non-depository market, financial intermediaries do not accept deposits but pull the payments of many people in the form of premiums or contributions and either invest it or provide credit to others. Hence, non-depository institutions form an important part of the economy. These institutions receive the public money because they offer other services than just the payment of interest. They can spread the financial risk of individual over a large group or provide investment services for greater returns or for a future income. Non-depository institutions include insurance companies, pension funds, security firms, government-sponsored enterprises, and finance companies. So these are all the financial markets based on security type. So for this session, I'm concluding here. In conclusion, I must say the whole overview I discussed here is very fundamental for financial analysis. So in the next session, I'll be teaching you about time value of money calculations, which is very vital for financial analysis. So thanks for staying